So thank you everybody for joining us for this MHA Autumn Budget 2021 and Spending Review update. This is a live webinar that's being recorded. Just have the next slide, please, Julie. Great. So we are looking for people to ask questions. There's a Q&A functionality at the bottom of your screens. If you put any questions that you have in there, as all participants are at the moment on mute, we will monitor those as we go through the session, answer them as we can, both live in the sessions and through that Q&A function. I'm sure based on Rishi's discussions yesterday, there might be lots of questions, not only in relation to what was announced, but perhaps some things that weren't announced. It was quite an interesting session from Rishi yesterday, and we've assembled an MHA team for you. Just go to the next slide, and that's from across the MHA network. So we have Alistair from Tate Walker, Tony from Moore & Smalley, and Alice and myself from McIntyre Hudson, and we're going to just give you an update of the tax highlights that were in the speech and in the supporting documents that we've had so far. As is usual with budgets, there will be some documentation that comes out in the weeks to come, so there might be some amendments and updates to follow, but this is the live sort of hot off the press update as we are. Obviously, Rishi's focus was on a post-COVID era, so paving the way for higher wages, higher skills, and increased productivity. Whether that's gets achieved will remain to be seen, but we're going to focus today on all the taxes and the wages aspects, and to give you that update and some insights as to what it really means for you. And what all those words and rhetorics and government outputs, how they can be used. So without any further ado, we'll move on to Tony. Thanks, Julie.
Thanks, Nigel. Yes, Tony Metcalf, tax partner. I specialise in income tax and capital taxes. Next slide, please. So as Nigel said, it was really a budget of what was not said rather than what was said. However, there are some considerable changes to income tax coming in from previously announced decisions made by the government. Primarily in the March budget, we had the freezing of the allowances. So the personal allowance, the basic rate band, high rate band, and the additional threshold, they were all frozen. They were frozen until 2026. Obviously, that creates an element of fiscal creep in that inflation and wages go up, and the consequence of that is that they recover more tax. So the rates remain the same. However, following on from a further announcement in relation to the social care levy, only 2 or 3 weeks ago, was the decision, along with national insurance that Nigel will cover later, to increase the dividend tax rate for next year. So from 6th of April 2022. The dividend tax rate will go up for dividends from UK companies on the basis that there'll be a 1.25% increase, so you can see all the bands increased accordingly. There is also an increase to the effective tax charge under what's called Section 455, which is the corporation tax charge for overdrawn directors' loan accounts that are not repaid before 9 months from the year end. So that will also increase to 33.75%. Next slide, please. So this is just trying to give you an idea of the impact of the freezing of those thresholds. An individual earning £60,000 would have a tax liability in 25-26 of 11,432. If those thresholds had increased in line with CPI, then their tax liability would have been 10,396. So an additional tax over that period, well, in that year, so obviously that increases every year, of over £1,000. And that's on the basis that wages stay in line with inflation. At the moment, we all appreciate that we might be in an inflationary environment and wages might also creep up. So that could be quite a considerable recovery of tax for the government. Additionally, making tax digital been deferred again, so effectively making tax digital for income tax payers will be brought in from the 6th of April 2024, and there's a further year of grace for large partnerships, general partnerships, they don't require to join tax digitalisation until the following year on the 6th of April 2025. Next slide, please. So one thing that did come out from the budget yesterday was actually, again, in a move to transition to making tax digital for income tax purposes, a proposed change to the way that profits are taxed for unincorporated businesses that do not use 31st of March or 5th of April year end. So from the 6th of April 2024, businesses will be taxed on the profits arising in the tax year. Previously, the proposals changed the basis period from a current year basis to a tax year basis, which would mean that taxing those profits on a tax year basis rather than accounting period. The target date to implement this was originally 2022-23. However, following further consultation, it has been announced that the tax year of transition will be the 23-24 tax year, and the new rules will come into force from the 6th of April 2024 as said. In line with the proposed date for making tax digital, in the year of change, businesses who do not have a year end of 31st March will actually be taxed on profits for an extended period, less any overlap relief of profits brought forward. There's no requirement to change the accounting year end. Businesses can retain their existing year ends, which is just the way in which they're going to be taxed. However, it may confuse matters, and ultimately we do expect that most businesses, unincorporated businesses, will move to a 31st March or 5th of April year end. Who does it affect? Well, effectively, as I mentioned, it's self-employed traders, all partnerships, professions that carry on through a vocation or a trade, trading trusts or non-resident companies with trading income. Anybody that suffers from higher profits in the transition year of 2023-24 will have the ability to spread that tax liability over the following 5 years. And probably the best way to show that is by an example. Next slide, please, Julie. So, under the current rules, if the business has a normal accounting year of 30th September, in 2022-23, based on the profits for that year, they would be assessable to £100,000. Yeah. In the following year, under the new rules, the individual will not only be taxed on the profits for the year ended 30th September 23, but also the profits up to the 31st of March 2024. The overlap profits brought forward from when the business originally started or there was a previous year end change will be deducted. So in this example, I'm assuming regular profits of £100,000 to make it easy. Normally would be assessed for the year end to September 2023 on 100,000, but we now then have to bring in an additional £50,000 being the 6 months up to the 31st of March, giving us a total of 150. Our overlap profits usually would be lower because they would generally be profits that were made at the beginning of an accounting, the beginning of the trade, should I say. So therefore, we'd always expect those profits to be lower. In some cases, they might not be, but generally they would be. And that would result in a taxable profit of 130,000 if those overlap profits were 20. So as you can see, this is an additional taxable profit of £30,000. And to alleviate the cash flow implications for many businesses, HMRC have suggested that £30,000 profit gets assessable over the following 5 years at the rate of £6,000 per year. So 2023-24 to 27-28 would be the years in which that catch-up would effectively be taxed. I did mention that most overlap profits are a little bit lower. Sometimes they might not be. There might be exceptional profits in the first year, or it might be a new business. In that instance, the overlap profit might reduce the taxable profits. In that instance, the taxpayer is allowed to take the benefit of that, and there is no need to spread that benefit. Next slide, please. As again, there's always a discussion about changes to capital gains tax and capital taxes, and this was the budget that wasn't. There was no announcement on the changes, no announcements to the main rate of capital gains tax at 20% or the rate of capital gains tax on residential property disposals of 28. Might it happen in the future budget? I think it seems to be Groundhog Day. We seem to keep saying this every time. The annual exemption, as previously announced in March, again remained 12,300 and will continue to go till April 2026. There were no changes to business assets disposal relief, so effectively the 10% tax available for the first £1 million of gains available to people carrying on in business. Again, the major changes to that, where the reduction was from 10 million to 1 million, was made some time ago. One thing that was changed, though, was the time limit for the reporting of capital gains on the disposal of residential property. So since 2020, tax residents have effectively been required to file a return and pay the associated tax on the sale of UK residential property, which is not covered by a relief or exemption, and that payment needs to have been made and the return within 30 days of the disposal. Since 2015, non-UK resident individuals have also required to file the 30-day return on any sale of any UK residential property. For any property disposals which complete on or after yesterday, the deadline for reporting and paying any associated tax is now 60 days rather than 30. This changes also clarifies that the UK tax residents where a gain arises in relation to a mixed use property, that is an element of residential and commercial, that the gain is actually only payable and reported on the residential element. So the system for completing 30-day returns is overly complex, and you can often struggle to register government gateways, accounts and complete the returns within the allocated 30-day window. So this change is welcome. As I noted before, disposals which are covered by relief, such as principal private residence relief, do not fall within these rules. Next slide. Again, similar with capital gains, not much action. The nil rate band has been frozen at 325,000 and will continue to be frozen till 2026. And this has remained at this level when we get to that date for 16 years. So you can appreciate that with rising property values, that has the incidence of increasing the number of estates subject to inheritance tax. The residence for nil rate band for houses for individuals passed down to their heirs remains the same and is frozen until 175,000 until April 26. There are no changes to any other reliefs or any other workings of the inheritance tax. So again, it was pretty sparse. Next slide, please. Pensions again. Again, lots of usual pre-budget hype as to what will happen on pensions. Is it a way for the Chancellor to raise significant amounts of tax? No major changes other than the one that I'll just talk about at the end of this slide. So the lifetime allowance effectively has already been frozen until April 26. There's no changes to high rate tax relief, and there's no changeable to the annual contribution limits. What will change, though, is the ability to access your pension. So those individuals born in 1973 or later will have to wait an additional 2 years before they're able to draw from their private pension. The Chancellor announced that the age at which pension benefits can be drawn without an authorised charge are increasing from 55 to 57 from 2028. And this follows the original hike from 50 to 55 in 2010. There was actually a consultation document issued in February this year to seek views on this. And with only 117 responses, HMRC felt they could actually move forward with it. So it's probably expected, bearing in mind the increase in the state pension age. So I suppose with increased expectancy, this comes an extra financial burden. Whilst the intention is obviously to encourage people to save into pension for their retirement, with the freezing of the lifetime allowances and the additional 2 years before people can actually access their pensions, I think we might find that tax relief on pensions might well be retained, but actually there might be an exit charge on a number of pensions, not only for the wealthy, which has always been the view in the past, but also for middle earners. So it's something to watch in the future. Next slide, please. As with everything else, I mean, I'm just touching on stamp duty, land tax there, residential. Obviously, the changes to the residential rates of stamp duty helped assist with the mini boom that we've had. All those rates have now reverted back to the original rates from the 1st of October this year, and they're shown on the slides there. There were no other announcements in any other form in relation to stamp duty, so commercial stamp duty, land tax remains the same, and also the 3% surcharge on second residential properties if bought or also if bought through a limited company. So that continues to apply. Next slide, please, Julie. And finally, maybe a bit niche this, but in relation to entities that deal with anti-money laundering and deal with clients' monies or deal with transactions where monies flow through, in relation to accountants, legal advisors, estate agents, letting agents, financial institutions, then what the government have introduced is an annual levy charged on firms undertaking such activities to effectively raise, in their view, £100 million per year to assist with the monitoring of money laundering. And the levy will be charged based on UK revenue in a financial year that effectively running from the 1st of April 22 to the 31st of March 23. The levies will be paid at the end of the year, meaning that the first payments will arise in the year 1st of April 23 to 24. And in the table, these are the proposed rates at the moment. It's not been fixed. There will be final legislation in the finance bill to set these levies, but these are an indication of the rates that will be payable by the firm handling clients' monies. So as I say, any turnover less than 10.2 million will be exempt. 10.2 to 36 million will be between 5 and 15, 36 to 1 billion, 30 to 50,000, and then greater than 1 billion, 150 to 250,000 annual levy. So all in all, not many changes to many taxations in relation to income tax and capital taxes, but that was a brief run-through summary of those changes. So now, if I may, I will pass on to Alistair to talk about corporate and business taxes.
Thank you very much, Tony, and hopefully everybody on the call can hear me okay. My name's Alistair Wilson. I'm a tax partner with MHA. Geographically, I'm based in the northeast of England, and my background is primarily in corporate taxes, but today I'm going to refer to that effectively as business taxes, because I think one of the key things that I would say to any corporate in the UK, taxes as a whole, you need to take a holistic view. We can move on to, I suppose, my first slide, just to move on to the next one. Julie, thank you very much. For anybody who reads or anybody who follows the budget, one of the first things that I would say that I do every single time I look at a budget is look at the policy costings that the Chancellor has included once you get into the detailed documents that are published immediately after the speech. The reason being, those costings show you what is really going on. It takes away some of the spin and enables you to see what the financial impact is actually going to be on business. Now, one of the key things that comes out whenever you look at the summary for the two budgets that the Chancellor has carried out this year, whilst the March 21 budget was very much a revenue raising budget, and that is quite clear whenever you look at the spending decisions compared to the tax policy decisions for March, the budget yesterday was very much spending rather than tax raising. And if you look at the two together, the Chancellor, whilst he says he is trying to balance the books, across the two budgets as a whole, he is spending significantly more, and in particular spending significantly more before 2023 compared to what he then raises across the lifetime of the economic forecast to underpin the budget. Now, a cynic might say, does that mean that an awful lot of the positive feelings that come from what will take place in terms of spending money, in terms of investment, etc., will actually have been felt before the next election occurs. And so will actually a lot of the pain that will be felt by businesses and taxpayers actually come after the next election. You might say I'm being cynical, but I think that actually the Chancellor's own economic forecasts and his own policy decision costings actually bear that out. And the reason for raising that is for businesses as a whole, they need to look at what the future costs of all of the decisions in the last two budgets are going to be, because a lot of the pain isn't actually going to be felt until 2023 and beyond. We can move on to the next slide, Julie. Then just on to the next slide after that. Thank you very much. So obviously the first key thing that businesses need to be aware of is that corporation tax is going to go up in 2023 to 25%. Now this isn't news from yesterday, rather it's news from the March 21 budget. It is, however, the key thing that companies need to be aware of, because that effectively represents a 30% or approximately 30% increase in terms of the rate of corporation tax. And businesses will be getting to the stage that, in particular, those who pay tax on quarterly instalment payments, that will start to flow through into cash flows. And so it is something that both from a deferred tax perspective and also a cash tax perspective, companies will start to feel quite quickly. And so companies do need to start factoring that in terms of their business plans. In terms of yesterday's announcements, probably the key thing in terms of the detail, what is known as the residential property developer tax, which is effectively a surcharge for residential property developers where they have profits exceeding £25 million a year. That is going to come into effect from April 2022. It is expected to raise several £billions a year, which will be used towards funding the remedial works in terms of cladding, which is something which impacts all across the UK. And it is something that is going to be charged at an additional 4% in the form of an additional corporation tax levy for businesses that are caught in that charge. If you're a residential property developer, the real thing that you would need to do at this stage is to understand whether or not you're going to be caught by the charge. And if so, again, add it to your cash flows. Can move on to the next slide, Julie. And this is really just a very brief visual, just so you can see the scale of the change. For any company, I would be recommending that they look at the impact in terms of their cash flows of this, because it has an impact in terms of your retained cash. It has an impact in terms of your ability to pay dividends. It will have an impact in terms of what you can do investment-wise. That step up in corporation tax, it is a very significant change, but it is something that the Chancellor has deferred in people's minds. In reality, people need to start looking at that sooner rather than later. We can move on to the next slide, Julie. In terms of the corporation tax rates, obviously, businesses just need to be aware that the associated companies rules do impact in terms of companies that are associated with each other, the thresholds at which they will start paying what is the higher rate of corporation tax. That is divided by the number of associated companies. So it's not as simple as saying, well, if my profits are more than £250,000, it's 25%, but less than that, it's 19%. It is, as usual with tax, a more complicated scenario. We can move on to the next slide, please. And the other thing that I would say the businesses need to remember, and again, this wasn't announced yesterday, it was announced in March, trade losses. There is increased flexibility at the moment in terms of what can be done with trade losses. There is an extended loss carryback period, which does apply effectively for accounting periods that end up to the 31st of March 2022, where instead of a one-year loss carryback, it could be a 3-year loss carryback. There are some limits and there are some rules in terms of how those apply. But the real point of reminding businesses that these exist, if, for example, you're a 31st December 2021 year end or a 31st December 2020 year end, you might want to think, well, what can I do with my losses? Am I best off carrying them back? am I best off carrying them forward because I may get relief at 25% in the future, whereas in reality, in the past, if you carry them back, you would be getting relief at 19%. So bear in mind that the decisions you make today could actually cost money compared to the money that you might save in the future at 25%. If we can move on to the next slide, please, Julie. In terms of the key changes yesterday, if I was to say what is the biggest change in terms of corporation tax for a broad base of businesses across the UK, in terms of reliefs and incentives, the biggest news overall would have been what is classed as the creative sector tax reliefs. Now, the creative sector tax reliefs apply to, for example, museums, galleries, exhibitions. They apply to theatres, to orchestras. Now, you might say that sounds like quite a small group. In reality, it's actually quite a large group of organisations across the UK. Every town and city is likely to have organisations that qualify for this in terms of this tax relief. How it works like the research and development tax relief in that you get an enhanced deduction in terms of what would be the costs that qualify, and it applies even if you're a not-for-profit organisation. And in reality, what they tend to then do is enable that loss that arises to then be surrendered for cash back. There were two major changes announced yesterday. First of all, the museums and galleries and exhibitions aspect of the relief had what was known as a sunset clause. It was due to come to an end at the end of March 2022. That has been extended up to March 2024. And then for museums, galleries, exhibitions, theatres and orchestras, the rates of relief have been increased substantially. The reason why the rates of relief have been increased substantially is that the cash that can be received if you surrender the loss that arises back to the Treasury, back to HMRC, so the cash is going to increase substantially. So this is a way of getting funding into what would be the cultural businesses in your region. And it is a really important thing which works very well. We do a lot of work on this type of tax relief with organisations who are within this regime, and it is a very positive piece of news from yesterday's budget. We can move on to the next slide, please. But in terms of the other changes that were announced for reliefs and incentives, we already knew due to a consultation that had gone on for probably the last 6 months, HMRC intend to include data and cloud computing costs within the qualifying costs for R&D claims. Now, to be honest, I don't think that that's going to be a huge difference for lots of claimants. I know that in certain scientific research organisations, they are expensive items to buy and expensive items to consume, etc. But for an awful lot of claimants, their data and cloud computing costs are actually relatively low. But it's a welcome extension. If I was to say what would have made a bigger change, if they had included, for example, the cost of bringing robotic process automation into your business, that would have been a more welcome change as far as I was concerned. They are, however, going to, later in the autumn, bring out more detail of some anti-avoidance measures or some restrictions in terms of R&D claims. The first one is going to be in relation to overseas expenditure. The government intend to restrict the relief to what is effectively UK expenditure. Now, if you're a UK business that has, for example, a software development team in Canada, software development team in Eastern Europe, for example, that's likely to impact upon what you can claim. At the same time, the government are also going to set out plans to tackle what they regard as abuse of the system and improve compliance within the system. And the Chancellor yesterday mentioned a statistic that those in our industry, the tax advice industry, are also very aware of, which is the amount of costs which are being claimed under the R&D tax relief system are twice those what the same businesses are suggesting whenever they are surveyed on an annual basis that they're actually spending. So the government are well aware, and the Chancellor clearly is directly aware, that it sounds like R&D claims are being inflated. And so watch this space. We would see that as an area that the government are going to tackle. The other measure that was announced in terms of reliefs, capital allowances and the annual investment allowance, that has been extended up to the end of March 2023. It's currently a level of £1 million in terms of the annual expenditure that can qualify for the annual investment allowance. The extension up to the end of March 2023, well, that just happens to coincide with the end of the super deduction. So you might say, well, that's a welcome extension. The real question is what comes after March 2023? Because at the moment, from March 2023, what would happen as currently announced is that the annual investment allowance would drop back to £200,000 a year and the super deduction would cease to exist, which would be a huge reduction in terms of tax reliefs for capital expenditure. So that's definitely a watch this space, because you can see in terms of revenue raising, without adjustment, that will cause a huge increase in terms of the tax cost of investing in capital equipment. We move on to the next slide, please. And really just to run through some of the other measures that were announced. These are probably things that if they apply to you, you're probably aware of them and you're probably up to date in terms of what is likely to happen. In the Northeast, we do have a Freeport site, and details were announced yesterday of the boundaries of all of the Freeport sites. Those are going to be useful in regions where there are strategic reasons in terms of either customs duties or in terms of investment in particular projects. In the Northeast, it's offshore wind that is the area that the government want to encourage. In terms of the banking surcharge, the government announced yesterday they were going to reduce the level of the banking surcharge down from 8% down to 3%. That is something that is helpful in terms of the banking sector, an area that the government want to encourage. We want London to be competitive compared to, for example, Frankfurt or Paris. Alison's going to cover the plastic packaging tax. This is really just to say we did get some further details of it yesterday. Likewise, if you're covered by either anti-hybrid rules or you're part of a group that is domiciled overseas, you may well want to look at some of the detail of the rules that came out yesterday. If I could just move on to my next slide, Julie. And then just finally, I'm just going to quickly cover off business rates. Now, business rates for lots of businesses and bricks and mortar businesses and those with commercial property, it's constantly an issue because the valuation of the properties is an area that can become contentious. For those carrying out a bricks and mortar business compared to an online business, at the moment it might feel unfair that you're being charged business rates whereas your online competitors are being charged substantially less. The Chancellor really kicked the issue down the road yesterday because he didn't announce any major reform, but he did say that it would be a consultation on online sales tax. And that really is to look at the options in terms of levelling measures up. Probably the most useful item that was announced yesterday was the temporary retail relief for business rates for retail, hospitality and leisure properties. This has been something that was done in the past and it has been very useful in the past. And so if you're in what would be retail, hospitality or leisure sectors, look to see, do your premises qualify? And if they do, that is likely to be something you want to make sure that you benefit from over the next 12 months. And then finally, on my section, there were a couple of measures announced on business rates, which were reliefs for investment in property improvements to ensure that the improvements themselves don't cause your rates to increase, because that's a little bit counterproductive. And then finally, there would be exemptions introduced for improvements to properties which encourage decarbonisation of commercial buildings, again, which fits in with the green agenda and the net zero strategy. And with that, I'm going to bring the business section to a conclusion, and I'm going to pass over to Alison.
Thanks, Alistair. Morning, everybody. I'm Alison Horner. I'm an indirect tax partner at MHA. I specialise in VAT and customs duty. So if we could go to the next slide, please, Julie. Thank you. So what were the key issues on indirect taxes? Well, overall, there was actually disappointment for the hospitality and tourism sector because they hoped that the reduced VAT rate might stay forever. Obviously, some good news on the business rates, but the VAT rate will go back up to 20% by the end of March 2022. It's just recently risen from 5% to 12.5% at the beginning of October. That VAT rate cut cost the Exchequer 4.7 billion. So you can see that VAT rate cuts at the moment, that revenue is very much needed in the Treasury coffers to pay for some of the measures, as Alistair showed in his table earlier. Another development is the alcohol duty reform that was announced, which will take place in 2023. But for us, it shows that the Chancellor now has, post-Brexit, freedom to set the UK's taxes and duties, which were previously had a very big influence from Europe, and we had to stay within certain remits. So whilst we started to play with the alcohol duty rates, there have been no sweeping changes yet to VAT rates, which the Chancellor now has scope to do what he wants with those. In the lead up to the budget, there were many calls for a cut to the 5% VAT rate for domestic fuel and power, but that was ignored, and again, understandably so, given that that would have cost the Exchequer 1.6 billion. Alistair mentioned plastic packaging tax. That is coming in on the 1st of April next year. Obviously, the green agenda is extremely high on everybody's agendas at the moment. It will look to raise £235 million per annum for the Treasury. It's going to be a self-administered tax. And basically, if you import or manufacture plastics over 10 tonnes in a year, then you're going to have to register for the plastics packaging tax and submit quarterly returns. It's going to impact packaging which is less than 30% recycled. It will be taxed at £200 per tonne. And it's not just, maybe initially people were thinking it's for manufacturers of plastic packaging, but it's also going to impact importers. So if you're importing from the rest of the world, say China, where maybe recycling is not as high on the agenda, then you, as an importer, you're going to have to know and measure the packaging that you have and understand how much recycling materials is in that packaging, otherwise there'll be a tax on it. I'll give you an example. Shrink wrapping around pallets, it will be exempt, but if you think about soft drinks and the packaging, the plastic packaging that is around them, then that type of packaging will be caught. So it's going to have a wide-reaching impact, and and businesses need to be aware of it, importers need to be aware of it and planning for it now. Next slide, please, Judy. Just wanted to look at the receipts, really, for indirect tax, which might give a flavour based on what Alistair was talking about earlier. So for the 6 months to September this year, indirect tax receipts are 75.3 billion. This is the VAT receipts specifically. And that's £47 billion higher than last year during the pandemic period. And pre-pandemic, annual VAT receipts were about 132 billion. The VAT payment deferrals that a lot of businesses quite rightly took advantage of fall into this reporting year. So you can see the way that things are flowing there. The payment deferrals and the 5% reduced rate for the hospitality sector had a big impact on VAT receipts last year. Also bear in mind that customs duties are now UK revenue post-Brexit. Previously, the duties that were collected by the UK, other than about 20% of them, which was held back for administration, the rest of it went to the European Union. So that's a potential game changer, isn't it, for the Treasury? But we don't have any oversight on those statistics as yet. But that is a big change to UK PLC following Brexit. I wanted to show you that the impact that giving VAT cuts brings. If you think about if there had been the VAT rate cut on fuel, if we'd kept the hospitality rate, you're looking at about £7 billion that wouldn't have been in the Treasury to pay for the measures that have just been announced. So moving on to the next slide, very quickly, fuel, travel and alcohol taxes, fuel duty frozen again for the 12th year, obviously greatly accepted by us all. Travel taxes, a little bit of tinkering around the edges, air passenger duty reduced for UK domestic flights, but increased for long-haul flights. And then the big one in the papers today about alcohol duty reform, obviously any reduction in a glass of rosé is greatly welcome, but those reforms will only come in 2023. It decreases the lower level alcohol such as Prosecco, rosé, fruit ciders, draft beer, but increases for strong alcohol. The planned annual rise has been frozen this year. Next slide, please. Some specific VAT changes, changes for two very, very specific areas. One to get our teeth into, sorry about that joke, is a VAT exemption will apply to dental prosthesis. That was specifically aimed at stopping VAT being charged on such goods being supplied to Northern Ireland due to the Northern Ireland Protocol, but will also apply to any dental prosthesis which are brought in from Europe as well. So that's greatly received by that sector. Also, with Northern Ireland on our minds, there's a lot of news about the Northern Ireland Protocol, and one thing that ended up happening as a result of this was that the second-hand car market was really impacted, and it meant that VAT was being charged on cars, whereas previously it would only have been on the margin. So it's been announced that in the interim, dealers can use the margin scheme, so that VAT is only declared on any profit margin, and it's planned that a new motor vehicle export refund scheme will be introduced to deal with that VAT charge going forward. But that's all yet to be agreed with the European Union. And I think my final slide is VAT in free ports. Alistair mentioned free ports. It's a big move for the UK post-Brexit. Goods that are entered and traded within those free ports are customs duty and VAT free. So processing and manufacturing can take place within a free port, but VAT legislation, the specific change I wanted to tell you about is VAT legislation is going to be brought in as an anti-avoidance measure to prevent those goods then being sold VAT free within the UK if they don't meet the free port criteria. So that will be introduced very soon. That's all I've got to talk to you today about indirect tax issues. I'm going to hand over to Nigel. Thank you very much.
Thanks, Alison. So that's great. So just to finally finish on employment taxes. So not a lot was announced in relation to employment taxes. Some of it was pre-announced, of course. So a small area, but very significant, I think we'll all agree. Obviously, we all heard about the national insurance increase, or this social care levy, as it will morph into from 2023. But from April 2022, we're going to have this 1.25% increase in national insurance. Obviously, we've already seen from the previous presentations that there'll be that 1.25% dividend tax as well. But significant, particularly when we look at the numbers that the costings that Alistair came up with, because this national insurance increase, this social care levy, that's what's going to generate the 12 to 14 billion pounds a year, which was the significant sort of balancing figure when it came to the tax take line that Alistair sort of produced earlier on. So something that again we've all got to look forward to from next April is however we call it, national insurance to start with, and then a social care levy beyond that, a 1.25% increase on employee and employer national insurance, whether you're and also for the self-employed as well in terms of their profits. So very, very significant. Leaked, mentioned weeks ago, but nevertheless confirmed and part of Rishi's budget, and certainly a key part of the budget announcements and the budget P&L, so to speak, from yesterday. Another thing that was leaked and obviously has a direct sort of correlation in relation to this is the increase in wages, the increase in the national minimum wage. Again, announced as normal. to take place from next April. It's kind of normal that they announce in the October what's going to happen from the following April. But I think it's quite significant when you look at it across the bandings, because I think the headline rate going up to £9.50 and the 6.6% increase, crikey, who wouldn't like a 6.6% pay rise? But that obviously has different impacts at different age levels, and therefore something from a budgeting perspective for employers to think about, not only where we've got sort of the increase in gross pay impacted by this national minimum wage, and obviously how that might impact on pay scales throughout the business, of course, keeping differentials between grades of employees. But then on top of all of that, we've got this extra national insurance as well. So potentially some very significant uplifts there in relation to the impact on the total sort of wage bill and therefore the total employment taxes for a business. So if I move on to the next slide, Julie. So as I say, not very much, but I mean, if we take what's happened in the spring budget and in the budget yesterday, there's quite a lot there in relation to taxes, and the freezing of personal allowances and the basic rate limits do have a significant impact over time, because as was previously mentioned, as salaries go up, obviously the tax take goes up, and if rates and allowances, certainly if allowances are remaining the same and rates are staying the same, then the overall tax take does increase. The same can be said for national insurance contributions. And one thing, again, something that was previously announced but has been confirmed finally in writing, is the changes in company car taxation. And actually the good news that if you have a full electric car as a company car, then obviously you pay 1% tax on 1% of the list price this year, rising to 2% from April 22, but it will stay at 2% for the following 2 years as well. So very significant in relation to full electric cars and ultra low emission vehicles as well. So plug-in hybrids, etc., will all benefit from those lower benefit in kind tax rates, with a view really to encouraging people to move to greener vehicles. We have COP26 around the corner. We have our environmental targets as a government that want to be met, and so encouraging people to get into greener cars has been on the agenda for a long time, and there's a significant tax break available that's now finally in writing being confirmed is going to be there for a few years to come. So new announcements, really tiny things, the things that come through every year. So if you have a company car or a company van and you have private fuel, then the scale charges are going up, and they're going up by CPI. That they won't be large amounts of increase. There'll be £100 here and £10 there on which tax is paid, but it kind of all adds up. And then the van benefit charge itself, so there's a separate charge for if you have a company van, that's going up by CPI as well. So again, that will be hundreds of pounds of additional taxable benefit in kind, but not overly significant amounts of money. Until the freeze, whilst we have a freeze in personal allowances, the national insurance contribution rates and thresholds are still going to go up next year, but from that point they'll be frozen, and again that's just by CPI, so only very small impacts. So more significant in terms of what remained unchanged. So thankfully, income tax rates remained unchanged. I mean, we've got corporation tax rates going up, we've got national insurance going up, we've got VAT at 20%, so it's quite a high rate. So thankfully, our tax rates outside of that and outside of the levy have remained unchanged. The pension reliefs, which obviously Tony touched on, because that's always muted and that always has a big impact. If there were changes to the tax reliefs on pension contributions, then obviously that could impact on employees and employers in relation to their contributions, but that's remaining unchanged. And so there are still opportunities out there, because another thing that remained unchanged was the ability to use salary sacrifice. So whether that's to save national insurance on sacrificing into a pension, and making sure that that's maximised. Some businesses haven't done it, others do it, but is that maximised enough, particularly without an extra 1.25% national insurance charge or levy coming? And also, because of these very low emission cars and their low benefit in kind taxation, they still qualify for salary sacrifice. Higher emission cars don't. There's an extra tax charge that was brought in back in 2017, but that's avoided if that car is below 75 grams of CO2. So certainly these very low emission vehicles, less than 50 grams with a plug-in or a full hybrid, still benefit from a salary sacrifice, which make them a very attractive employee benefit, and as a consequence save tax and national insurance. So some things to think about there, but for employment taxes generally, not very much to say. But there's so much going on that that's probably a little bit of a relief, really. So yeah, that concludes our updates from myself and my colleagues as specialists in these areas. There have been some questions which have been answered sort of along the way, but now we just open the whole session up to any questions that participants would like to post before we finish. So one question that's come in: do we believe the social levy will have any relief as the apprenticeship levy does? No, is the short answer. I mean, it's a, for want of a better phrase, it's a tax raising program, and so apprenticeship levy, which again is another 0.5% on the pay bill, that was to encourage and to support where we are in terms of the perceived skill gap we have in this country. Clearly, that's very clear in some sectors, as we've seen in the press over recent months. So the apprenticeship levy, therefore, is a genuine levy to support an additional activity in relation to training and improving skills of people. And therefore, whilst there's a charge, there's also a relief that goes alongside that. The social care levy is in essence just a tax increase, whether we call that national insurance or whether we call that a levy. That's obviously going to be, that money is going to be used to fund the public sector, the health sector, and at some point social care, but there won't be any reliefs that will come off the back of that. I'm afraid it's an extra sort of tax. The other question is, can we get a copy of the slides? Yes, the unsung heroes in the background, Deepa, Sarah and Julie, next slide, Julie, you'll have heard all the way through. They will produce the recording and the slides, and they will be available, I think, through our website later on. So yes, you will get a copy of these, so that you can reflect on all of the words of wisdom and all of the efforts that we've made to find the small print in all of the budget statements, because it was pretty difficult this time to find things to say. So there's one there on corporation tax. So Alistair, do you want to pick that one up?
Yeah, so to remain at 19%, you have to have, well, from April 2023, you'll have to have adjusted taxable profits of less than £50,000 a year. But the key point being the adjusted, in that it's divided by the number of associated companies that you have, etc. So the straight answer is £50,000 a year, but you need to work out what that £50,000 a year actually means in your context. Great.
So that seems to be all the questions for now. So I'll just wrap up by saying thank you to the presenters, obviously, and thank you to the participants. We've had a pretty constant couple of 100 people on the session, so thank you very much. And yeah, if we're as always, the MHA team are here to assist as and when other queries come up. So thank you.